Brian, the bond market is a huge market. Why are we talking about annuities as it relates to the bond market?
Yeah, the bond market is a huge market. In fact, if you took every publicly traded stock in the world and put the value of that in one pile, and then you put the value of all the bonds in the world in another pile, that pile would be way bigger. So there's more money invested in debt, corporate or government debt, than there is in value of all publicly traded companies combined, which is really an odd thing. So I want to make this a topic because likely a lot of your money is invested in bonds. If it's the biggest investment category there is, bigger than all the stocks in the world, bigger than all the real estate in the world, bigger than all the annuities in the world, it's the biggest one. So you'd say, well, okay, it's the biggest one, it must be good, right? Well, maybe not so much. Bonds right now are paying historically low yields. And one of the questions I'm asked, well, yeah, but they're safe, right? They're safe when interest rates are falling because you're making money. But when interest rates, if they increase, you lose money on bonds. They are not safe. You can lose money on bonds. One of the ways you can lose is, let's say you bought a 30-year treasury and it's paying 1% a year. And so you know you're going to get that for 30 years. Well, a year later, they're paying 2%. So now you want to sell your treasury. And you say, well, you're going to get 1% less than what you could for 29 more years. You're going to lose 29% off this treasury I just bought. Would you like to buy it? Well, sure, I'll buy it from you, but I'll give you 75 cents on the dollar. You know, what? I lost 25% on my treasury I held for 1 year? I thought that was a safe investment. No, it is not safe. You can lose money on bonds. That was an extreme example, but I think it illustrated my point. So bonds aren't necessarily safe when interest rates are really low and you expect them to increase. Do they pay a decent yield? Well, I know that there's some places in the world you can buy a 10-year treasury, and if you give them $100,000 today, they promise in 10 years to give you $99,000 back. I don't think that's a great investment personally. I hope you don't either. So bonds are certainly, I'm not saying they're a terrible asset class or anything. They've been great as interest rates have been falling for years and years, and they used to pay really good yields. They just don't right now. So a lot of people are coming to me saying, do you have something I can have investment that's not the stock market, but can be used as a bond substitute? So that's what we're talking about here.
Brian, who would be best suited to use an annuity as a bond substitute?
Yeah, so if you're concerned about, again, the loss and you're not getting that big a return anyway, you might consider a fixed index annuity as a bond substitute, because there are fixed index annuities that offer a percentage of the S&P 500 gains or gains of different indexes up to a ceiling that can be a lot better than the negative yields that some of these bonds offer or the very paltry yields that they offer. So it's just a way to kind of add some zing to your safe investments. And again, I'm not even comparing safety, because bonds can lose money, but fixed index annuities for accumulation generally have a floor of 0. They can't lose money. So if you want to improve your investment results on the downside, solidify that, and maybe have a little higher upside if you think interest rates are going to go up, especially, then you want to consider a fixed index annuity, an accumulation one, as opposed to a bond as a substitute.
Why would someone not want to use a fixed index annuity as a bond substitute?
Yeah, so bonds are 100% liquid. So if you're in a bond and you decide Tuesday you want to sell it, you can sell it. Fixed index annuities have surrender periods. It might be 3 years, 5 years, 7 years, 10 years. And if you take all your money out, you're going to pay a significant surrender charge. So if you need liquidity, you might want to go with bonds. However, most fixed index annuities do allow for a 10% free withdrawal, they call it. So you can take up to 10% out for liquidity each year without paying any surrender fee. But that is a major difference right there, is that the bonds are much more liquid than a fixed index annuity.
Can you give me an example of a client that you have helped using a fixed index annuity as a bond substitute?
Yeah, I use the fixed index annuities as accumulation when we want to protect against decreases in the market. So we've had many, they call them black swan events, where things that you just couldn't see it happening, and it doesn't happen very often. But we keep seeing black swan events. We saw one with a .com 9/11 2008 with the banking, we had with COVID when it started. Markets react very poorly sometimes. Now, most bonds held up during those times just fine, but they're, again, going forward, we don't know that it's going to continue on that path. And so I would say that we have not seen, because interest rates have been falling for a lot of years in a row now, we have not seen people have really negative reactions to bonds unless you're in high yield bonds. You might have lost a lot of money during those black swan events. But I think going forward, many people are thinking we're at a low in the interest rate world for our lifetime. Rates will go up. When rates go up, it's a mathematical equation. The value of bonds go down. So pretty much anybody that's listening to this and watching this that thinks that interest rates are going to go up in the future, now might be the best time to consider not being heavy in your bond portfolio.
Good information, Brian. Thanks for telling us more about using fixed index annuities as a bond substitute.